Welcome. I am so excited for today. We are talking all things investment from technology and its role in investing to trending investments to financial planning for women and the great wealth transfer. And I'm here with Robert Wyrick and Savannah Krenek with Post Oak Wealth Advisors, which are my personal advisors, and the amount of growth and knowledge we have gained since being with you guys is incredible. So just so glad to have you.
Thank you so much. We're happy to be here. These are fun topics for us.
And Rob, your background is incredible, and you've been featured on CNBC and USA Today. And tell me a little bit about how you got here.
You know what? It's literally the only thing I've ever done.
Really?
I got an internship when I was going to University of Houston with a New York-based firm and fell in love with it. Never even knew what a stock was, a bond was, had no exposure to the industry. Wow. And I honestly just got so lucky. I got hired by, at the time, a firm that was the oldest firm in Texas, Underwood Newhouse and Company. And I was able to get trained, and I didn't realize at the time how fortunate I was, in all areas, including institutional trading, managing money for public funds, insurance companies, taxable fixed income, and just fell in love with it. And literally, it's all I've done ever since. I had a firm. It was acquired years ago, and we started Post Oak from scratch less than 10 years ago to be a boutique firm, and just loving every minute of it.
Oh, my goodness. And Savannah, you blow me away because you're such an established young professional. And I love how you both have different generations that come together, and you're able to offer advice to a great variety of clientele. And your story is emotional, how you started, but I think it gives a lot of sense to your passion and how you really help people. You know, would you like to, tell us a little bit about how you?
Sure. Thank you for the introduction.
Yeah.
My story is a little bit different. So my mother passed away whenever I was a teenager, and I was left to figure it out with no idea of what I was doing, no knowledge of what I was doing at all. And that kind of triggered something inside of me to be that person that could help someone else in that situation if it ever occurred to them. And I have clients that I've had to do that for since I've started with Rob. And similar to him, I feel so lucky too, because since starting with him, I've just learned so much, and I've been able to do so much and advance in my career in ways that I never thought I would be able to.
That's an incredible story.
And she went through the financial planning program at University of Houston, which is really one of the best. Yeah, one of the best in the state. And so highly trained and credentialed, and she's just a blessing to our firm. Yeah.
So a lot of our topics today are about millennials and Gen Z and how they're investing. And I hear about this movement, this FIRE movement, about the younger generation wanting to retire early. Like, tell me a little bit about that.
I think they're onto something.
Really?
I think they're onto something. And that's certainly your generation. But so we do see it.
Okay.
And so I don't know if you want to address some of the things that you hear mostly from your generation, but it's really just about planning.
To start, the FIRE movement is financial independence, retire early. And it truly is a trend right now with the younger generation, because we are valuing having our own time and getting to do what we want with our lives. And a lot of that is surrounding retiring early.
Okay.
And there are a few aspects that go into that. You have to be an aggressive saver. You have to live a frugal lifestyle in the meantime. And then you have to plan appropriately. But it's totally possible. And we see people do it. We have clients.
Yeah, we had a couple in the office last week, and I think their goal is to retire at 45 or so.
That was my question. What is the age?
We do see it. And so it just depends. But one of the things that we often talk about is sort of understanding the rules of the road in terms of how different monies are taxed.
Okay.
And so, for example, the way a lot of us save is through 401ks and SEPs and pre-tax accounts, which is great, right? We get the tax deduction now. But if a person wants to retire before 59 and a half, you have to have access to funds that aren't subject to IRS penalties.
True.
And so we always talk about the fact that we all have the opportunity to have three different, so not all money is taxed the same.
Okay.
And we all have an opportunity to have three different sorts of tax buckets, if you will. One is pre-tax, which are the things we talked about, IRAs, 401ks. And those are fantastic now, right, because we get the tax deduction. They're the least tax efficient vehicle to have in retirement because all the money that comes out is taxed as ordinary income.
Right.
And so when we talk about the FIRE movement, we really focus a lot on that second bucket, which is the after-tax bucket. right? So if you have all these pre-tax dollars that you can't access until 59.5, that doesn't help you a lot. And then, of course, the third bucket is the tax-free bucket, which is a Roth.
Okay.
And so in the case of this couple that was in the other day, we said, listen, we did a sort of a deep analysis for them. And it's like, listen, you guys have the potential to be able to do it, but here's where you need to focus, right? You need to focus on that after-tax savings and do it tax efficiently. Because the mistake a lot of people make is they'll invest after-tax money, and maybe they're doing some day trading, or maybe they're investing in ways that aren't tax efficient, and they get a big 1099 at the end of the year. That isn't necessarily what anybody wants to get. And so accumulating tax efficiently, dividends on domestic companies are taxed at 15%, which is very favorable.
Okay.
Which by the way isn't true for mutual funds and ETFs. And so understanding the tax rules, understanding how dividends are taxed, understanding how long-term capital gains are taxed, and just keeping it tax efficient. And yes, like Savannah said, save like crazy. A funny story. So I have this young Vietnamese guy I know. We were talking one day. He's a hairstylist, and people talk to me about money, right? Because that's what I do.
Right.
And I was talking about the fact that I always told my kids to save 10% of what they make. And he said, Rob, in my culture, he goes, we were taught to live on 10% and save 90% of what we make. And he did it, right? I mean, most people can't do that, right? But I mean, that's extreme.
Yeah.
That's extreme. But I guess it's a function of how dedicated a person is.
Wow.
I tell a funny story too. One time, Mel and I were out to dinner with some very wealthy friends and clients, and we did Melanie's my wife, by the way, and so we do what we do. We had some drinks and appetizers, and just kind of threw down and had a great time. And this other couple, they got sort of this big platter, and they split it. I think they each had tea. And at the end of the dinner, I think our bill was like $150, and theirs was maybe $25. And so if somebody really, right, so that's true. I don't want to be that person, right? But perhaps somewhere between not caring and is
somewhere
probably
there is a happy ground.
is probably the right place to be. But to Savannah's point, it's all about really being dedicated to it, really being dedicated to savings and understanding the rules of the road.
And the living below your means, what are some good pointers to?
You just have to have a frugal lifestyle.
Okay.
You make the sacrifice now so that you can enjoy it later. And it truly is a sacrifice. You have to be an aggressive saver. And there's other components that go into it, investing wisely. But just simple living is truly the key.
No DoorDash, no Uber Eats, right?
Stay off at Amazon Prime.
Yeah, Uber.
There's a
all
lot
the
that are
things.
just guzzling. Yeah.
The financial planning term that's used is called wealth leakage.
Right.
And we all have it, right? I mean, it's so easy. Sometimes we feel like a conduit where money flows through us and just out sort of the other end. And people that we work with, even people that didn't seek to retire early, but retired with very substantial savings, were always frugal. When they got raises, they didn't increase their standard of living, right? There was a book written years ago called The Millionaire Next Door by Robert Stanley, I think it is. He was a professor at one of the universities. And he did sort of this largest study of millionaires in the country and wrote this book called The Millionaire Next Door. And not surprising to us, because this is our typical client, they probably live in an average house.
Right.
They probably drive an F-150, and they watch their dollars. They spend and they enjoy their life. And that's how they're retiring with tens of millions of dollars in some cases, not because they made rock star money, but because they were just frugal. And so I think it's just doing that on steroids and just really focusing early.
Yeah.
The problem is most people in their 20s aren't really focused on that, and because they're just sort of making their first money oftentimes.
Yeah, and they're just romanticized by what they see on social media and all the different, brands.
Very
and
much.
It's just
a big distraction.
Yeah. And then now that we don't have checks anymore, it's all debit. I mean, balancing the checkbook isn't a thing anymore.
That's
I mean,
true.
it's just people have to go through their accounts and really see where all that money is going. And so it's good that the youth are catching on to realize they need to change that.
Yeah.
And is it too late for people to start this process if someone's 30 or 35 is like, hey, I want to retire in 15 years?
I don't think so. I think as long as they are actually dedicated to the goal, it's definitely possible. But everybody is in their own individual circumstance.
Right.
It's going to depend on a few factors: how much they make, how much they save, how much they spend, and what their timeline is. But it's definitely possible. Yeah.
And that's a really good point, because any one of those variables, and so if you look at the amount that a person has saved, how much they're continuing to save, what their rate of return is, when they want to retire. So you bake in all these variables, and if you tweak any of them just a little bit, it can really change the outcome of the plan quite significantly. But if a person is of that mind, start early, start understanding, how these things work. And,
Is there a drawback to this method? a little bit, or more like long term? Like, will these funds last through their 80s?
Well, that's the whole key. Is if you want to actually dedicate yourself to this movement, you have to plan in order for those funds to last. Nobody wants to go back to work at 80 years old.
Yeah.
Well, and health insurance is a big deal, right? I mean, so we have even very wealthy clients that are working until 65 because until they get on Medicare. And so healthcare is a big deal. You're no longer paying into Social Security if you retire early, so that your Social Security benefit is probably going to be really low when you do get to that point. So listen, it's certainly doable.
Right.
And but again, just kind of understanding what some of the pitfalls may be.
Okay, well, let's talk about a little bit about these viral investing trends we see on. As soon as I like one on TikTok, I start seeing flooded of all these meme stocks like GameStop and AMC. What is your take on that whole, situation?
Oh boy. So information has certainly been democratized.
Okay.
But I often say people shouldn't confuse information for knowledge. And like I watched, actually, because I was curious, the podcast, or I don't know if it was on Reddit, was it Roaring Kitty, the guy that was sort of behind the interesting guy, right? I don't know what his deal is, but he had on this weird attire. But he even laughed at one point. He said, don't listen to me. He goes, I'm just, well, why would anybody listen to me? He thought it was really kind of silly. But people do, right? And everybody, look, it's human nature to want to hit a home run. And in some cases, people can do this and they can hit a home run, even though fundamentally the investment may be completely flawed. And so what I would say to that, and Savannah, you can add to this, but what I would say to that is just be cautious. And I would view that as more of just sort of high-risk gambling money. And there's nothing wrong with that. If a person wants to take a little bit of money and go buy some GameStop or go buy some Reddit or whichever, what was the other
AMC.
one? Yeah, AMC. Fundamentally, these companies were broken. And the reason that some of these meme stocks really took off is because big institutional investors were short these stocks. And I don't want to get too technical, but if you have a big institution that is short a stock, and it really starts to go up in price, they have to what's referred to as cover their short, and it just exponentially drives the price of the stock up. So what a lot of these people on Reddit are doing is they're finding stocks that have a big short position by institutions, and they're trying to squeeze them out by running the stock price up. So it's a strategy. It's a risky play. It's fun. I like to watch it, but I wouldn't confuse it for an actual investment strategy.
Right. And what should a person, when they see this road they could head to, where do they go to figure out if it's the right thing or it's not? I mean, is it really reaching out to financial advisors like yourself? I mean, you can't just go on to Reddit and everybody.
Well, that's part of it. And I have friends who have asked me about the whole GameStop situation, or AMC, my age group. And I have to explain to them that this is not a long-term strategy.
Right.
Like Rob said, everybody wants to hit a home run. If you made money off of it, that's amazing, awesome.
And some people did,
But it's not a long-term strategy, and it's not a value strategy that we should be having long-term.
Yeah. I think that's a valid
there he
point.
goes. So don't think about it.
Yeah.
don't think about it, people.
Yeah, it's fun. And like I said, it's Vegas money. If you want to take a little bit of Vegas money and do it, who knows?
What's the difference between a growth stock and a value stock?
That's a really good question. So essentially, a person would view a stock as a value stock if it is deemed to be undervalued or beaten up because it's out. Maybe the sector is out of favor.
Okay.
Or the company had a bad quarter a couple of years ago and it never recovered. So when you buy a stock, always the goal is for it to go up in value. But if you buy a stock that's deemed to be a value stock, you're buying it because you think it's undervalued relative to where it should be.
It's been beat up a little.
It's been beat up. A growth stock you're buying because the company has momentum, because their earnings are continuing to go up, their earnings are increasing, and so you're buying that stock because they're a growing company.
Okay.
Historically, up until probably 15 years ago, value investing outperformed everything. Warren Buffett is probably the most successful value investor of our time. But over the last decade or more, it's growth stocks. Look, I mean, think of the companies that we use on a daily basis: Amazon, Apple, Microsoft. I mean, go down the list.
Google,
right? Facebook. And so these are companies that are really accelerated. And if you look at the earnings of these companies, there's nothing that even comes close. I mean, they're producing double-digit growth year over year over year. They're probably more volatile than an undervalued insurance company.
Right.
But this is where the growth has been. And if you look at the returns on some of these stocks over, whatever period of time, it's been, they're going to be more volatile. And then of course you throw AI into the equation, and then you really start to see companies that people thought may have been starting to get overvalued, that perhaps they're not. If they're going to lead the race to in this whole I don't want to say movement. What's the right word? This whole shift.
Right.
This whole shift to AI. The chip makers, they have to have chips.
Right.
Right. And all the companies we just mentioned are sort of racing to kind of be at the forefront of that. And so, but it's important to have both. Right. It's important to have some value investments in a portfolio, because they will behave differently in different markets. And that kind of goes to the stress testing and how you analyze portfolio analytics. But so you want to have both. But the real money, at least lately, has been in growth stocks.
In growth stocks.
Yeah.
And it seems like a lot of them are technology, but do you recommend splitting up into medical or other type of business sectors?
Technology's been hot this year.
Yeah.
It's been on a run, but that goes back to just portfolio management 101 is diversification.
Okay.
And so you have to diversify.
You do. And so technology makes up about 33% of the S&P 500. And it's okay to be a little overweight technology,
right,
because that's where the growth has been. And maybe you underweight something else,
right?
Maybe you underweight, energy is an interesting subject, because it's not, not a very hot area that people talk. I mean, in Houston, I guess it is, but energy stocks. But energy usage is expected to go up by 30% over the next 5 years because of AI and because of Bitcoin mining. It's already increased, but AI, the computing power that it takes, going to create this huge need for energy. And so you're going to hear more talk about nuclear and solar and probably more drilling. But yeah, I know. Yeah, exactly.
That's another podcast.
Yeah, that's a whole other podcast. Exactly. That's a whole other one.
According to data right now, we're experiencing highest numbers of the great wealth transfer right now, of, generational wealth that's being accumulated by people who didn't have it once before. And there's a lot of people not prepared for that. Tell me a little bit about what you're experiencing and how you help these people when they are left inheritance and properties and all of that.
Well, you said it correctly. I mean, I believe this is the largest transfer of wealth in American history, from boomers to the next generation. And we see it all the time on both sides, right? We have clients that pass, and then we have clients that are inheriting money, sometimes children, sometimes a spouse. Oh my gosh. I mean, so we can look at it from two perspectives. So from a planning perspective for the person with the money, just making sure, I mean, most of it isn't overly complicated, but making sure, for example, that beneficiary designations are tucked in.
Okay.
We've actually seen some nightmare scenarios where perhaps it's a second marriage and a person has a large 401k and they never took time to change their beneficiary designation, and the money doesn't go where they want it to go.
Okay.
And understanding that those beneficiary designations supersede all other estate planning you can do.
And then to that note, having estate documents in place.
Right.
Wills, power of attorney, anything like that is just necessary for your assets to pass forward.
Right.
Having those documents tidy and up to date, so that when in the event of a timely death or untimely death, your beneficiaries are taken care of, and it's easy.
Yeah, and again, you'll hear us talk a lot about tax planning, but understanding that different types of inherited money are also taxed differently.
Okay.
So if you understand real estate very well, and so if, for example, somebody inherits a piece of real estate that they purchased for $100,000, 20 years ago, and it's now worth $1 million, all those unrealized capital gains go away when they pass. It's called a step up in cost basis. And so if a person has a $100,000 cost basis, now the real estate's worth $1 million. If they sold it in their lifetime, they would have a $900,000 capital gain. Their beneficiaries have none. If they're turned around and sold it, the next day they get that the value is established at the date of the parent's death. And so understanding sort of how cost basis works, and for both generations, because sometimes an older client will specifically hang on to an investment or a property or whatever because they realize that it's not worth paying the taxes when their kids are going to get it in 10 years anyway. Roth IRAs passed multi-generationally tax-free. And so Roth IRAs are really a phenomenal tool for transferring wealth. I think that statistically, and we see it in our practice, people tend to accumulate the vast portion of their wealth, especially if they're corporate employees, through 401ks.
Okay.
And sort of understanding how that works, right? If your spouse inherits an IRA, then they're able to sort of take those distributions over. Like when your kids inherit that as a non-spouse, then they're forced to take it out over 10 years, which means that they're going to pay a significant amount of taxes to sort of hasten and rush those distributions over a short period of time.
And those rules can get even more complicated whenever you start talking about RMDs.
Right.
And being a qualified beneficiary. It changes account by account and situation by situation.
Very true.
And it's all very complicated, it really is, but it's ultimately very simple if you know the types of accounts and how they transfer.
Yeah, so the first thing when you get an inheritance is call y'all. Because there's no way for
That's the
someone to be
majority
like,
of how it works.
Yeah.
We find out after the fact.
Right.
And then we're kind of working all of our angles to track the funds and figure out how each account needs to be handled.
Right, because there could be so many unforeseen, taxes that are owed, or like just so many complications.
And then if you get into really large estates and you start looking at an estate tax issue, and the estate tax rules are sunsetting in 26, and it's gonna be a much lower number. But yeah, I mean, and also, as a person who would be inheriting the money, their children, sort of assuming maybe both spouses have passed, using that money in such a way that it's going to really allow them to have freedom for a long time, instead of just sort of blowing it up and buying Ferraris or whatever. and so it gives, and we have this conversation, listen, this is a game-changing life event for you. And then we build an analysis to show them that even at a moderate rate of return, you're good forever.
Right.
You're good forever.
And for your clients who are preparing for how they're going to leave their estate, do you recommend when they have adult children at certain ages, they can really handle the wealth? I mean, like we have 20-year-olds, and like I wouldn't leave. I would do it in phases. Like when they turn 30 or 35, are there different like age parameters?
We do see a lot of that, and that's just smart planning, right? And it's usually where a trust comes in, because attorneys call it control from the grave, where you can just sort of disperse. Yeah, exactly. And in some, we have clients that have kids that would be considered spendthrifts, and they're going to sort of blow through it, and they don't want them to have access to it right away, or at different ages or different milestones. Some people get really, really controlling, and they want to make sure that it, if the kid goes to school or whatever. But yeah, I think that's important, right? I mean, we all tend to know our kids, and also look, we mature over time. I mean, I think about how I look at money now versus when I was 20. It's completely different. I wasn't on that FIRE movement, and so
and everyone does treat it differently. I'm grateful that I at least had a baseline level of knowledge whenever my mother passed, to put myself through college.
That's incredible.
And put the money to good use to get a degree.
Wow.
But so many people don't know to do that.
Right.
Especially as an 18-year-old. And even more so at 21, 25. Not everybody knows their own children, not everyone.
Right.
But you have to kind of set your own parameters for what's appropriate for your family.
Yeah,
exactly.
And I don't think there's enough information out there, and I think some people are intimidated by seeking, advice from a wealth advisor, because they feel like it's a huge investment, and it really isn't.
Right. It can sometimes be eye-opening in a positive way.
Yeah.
I mean, some people are, we sort of get this deer in the headlights look and thinking it's this big daunting task, but oftentimes it's just sort of liberating, because you can see these things on paper and know that, listen, I'm actually going to be okay.
They're going to be in good hands with you all. And that's how we feel with our investments with your company.
Oh my gosh, thank you so much.
Yeah, that's like no one else could be on this podcast but you guys.
Thank you so much.
Another really important topic as far as the great wealth transfer is, Rob and I have talked about this before, his generation doesn't talk about money the way that mine does.
Really?
We are very open with what we're doing with our investments, what we're saving, our salaries.
Right.
Whereas I don't really see that a lot from the older generation.
Right.
And so for that reason, a lot of children and grandchildren don't even know what they might possibly be getting. And it's not always appropriate to inform them 100%, but in my situation, I didn't know where to go looking for 401ks or IRAs or what types of assets were out there to find. And so it's very important to have some sort of baseline knowledge with your beneficiaries of where to go and who to contact and what to do.
Very, very valid point. It's even all the way down to passwords. We've seen even one person pass within a couple, and that person paid all the bills. we had this literally happen last year, and it's a very, very high-profile attorney in Houston, but his wife handled all the bills. She passed away sort of untimely. His water, he was in Colorado hanging out at his house. His water got cut off. His electricity got cut off, right? There's the car finance company was calling him because he had no idea how to even access the passwords to pay the bills. So just basic things like that. And again, you're right. I mean, not every person wants to sort of discuss their finances in full with their kids. No. Well, first of all, you don't want to make them lazy, like especially if they know they're going to get a big chunk of money at some point. True. And so you see a lot of ultra wealthy people like Warren Buffett who aren't leaving much of anything to their kids because they don't want to sort of ruin them. But just having let them have some base level knowledge so they know at least who to call.
I do have a running spreadsheet in the middle of my desktop. It says open if I die.
That's smart.
Perfect. And I told all the kids because Dad's going to forget where it goes.
Yeah.
Where it is. But I have what's auto paid, what's not. I do have all my passwords there and all the links to everything in there. So just put a spreadsheet together, y'all. Just make sure they know where it is. And
it's really important because we see it more often than we should. We had a client pass away on December 31st, actually, and he handled everything for his wife. She didn't know anything. And Savannah, it was just one of the most amazing things she's ever done. So this lady's daughter is helping her because the wife just didn't know anything. And so Savannah, and we don't do this, literally went to their house, said, listen, we have to find a budget for you guys because the amount of money that you think you need every month, it's not going to last for your lifetime. Oh, wow. And so let's establish a budget. Let's figure out what your expenses really are.
That's amazing.
Yeah, and I thought it was amazing. Thank you.
But
because she needed that.
That is why I do what I do. Yeah. Those people right there.
Yeah, they don't because you're looking out for them, and that just takes such passion for this business, and
truly,
you're in the right field. Yeah,
truly,
sure.
Truly.
Wow. And technology now and AI and role of technology, they're starting to analyze, where you should invest your money. What do you feel how technology plays in investing now?
It just gets better and better.
Really?
Yeah, it really does. And I think so there are tools that are available to us that I think ultimately will be available to individual investors. And I'll give you a couple of examples. So, one way to invest is to own the S&P 500.
Right.
Very simple, easy way, very good way to invest.
Yeah.
And so about 5 years ago or so, the technology came about to start doing what was called direct indexing, where you could own maybe 200 stocks in the S&P, but you would still mirror the S&P almost to the penny in performance. And the reason people would do that is because then they can tax harvest along the way. But the point is, it takes so much data to understand how to put together only 200 companies to literally completely mirror the S&P. And so we call it data analytics. And so for every stock that's publicly traded, there are probably 160 or more points of data on that individual company, everything from technical data to how it interacts within its sector and other sectors. And so right now it's outrageously expensive, and it's still it's available to us. Not all firms have it.
Okay.
But I would imagine that, and so of course we use that. We're analyzing stock portfolios, and we look at all these points of data and how are these stocks going to interact with each other. There's certain things you can't predict, right? You can't predict a CrowdStrike causing a global IT outage. That's not a factor you can look at. But so those things happen. That's the risk of investing. But I think that there is more and more information out there, and there's more technology, and there's just no reason to believe that over the next few years that technology is not going to be completely in the hands of individuals. And which is great, right? Again, we talk about the democratization of information, and we don't have a lock on all the good ideas. And so if consumers are able to access that kind of information, right now I see a lot of platforms that sort of purport to do that, and they really don't.
Okay.
Right? But it's getting better.
But as of right now, publicly accessible, there's not very many. But through your firm, you have those. I mean,
we have
tools.
It, but most individual investors aren't going to pay $100,000 for a piece of software.
No.
Because it just doesn't make sense. But again, I mean, AI is changing lots of that. Automation's changing lots of that. And so that I would imagine that'll be coming, which will be wonderful, right? The more information, the better.
Yeah. Does it analyze risk detection and any of that?
Very much.
Really?
And some of those tools are available now. So there are, I'm trying to think of the name of a couple of them, but there are some very affordable tools right now where you can sort of insert your portfolio, upload your portfolio, and it'll measure risk metrics in terms of how much risk you're taking relative to your risk tolerance,
Okay.
or how much risk you're taking relative to the S&P 500. So there are some good tools right now that do that are available to
Interesting.
to individual
I
investors.
had no idea until we were discussing this that was even a thing.
Yeah.
Yeah.
Yeah, very much so.
Crazy. What is stress testing?
It's that, right?
Okay.
It's looking at how your portfolio is likely to behave given certain very tough situations in the market.
Okay.
Like how might a portfolio have behaved in 2008? You know, in the big financial crisis, how might a portfolio behave if Iran and Israel go to war, or if if the Fed missteps and we slide into a bit of a recession? And so stress testing is something we use a lot. And those tools are also available to some degree to individual investors just to help understand, because there's risks in investing and everybody has their own risk tolerance. And it's helpful to understand how, if you stress test a portfolio, what it might look like. And I think a lot of people would be surprised, right? So if you go, and these are all good firms, but if you go to any of the big firms like Vanguard or Fidelity or Schwab, they all have these sort of model portfolios that are asset allocation portfolios. They're based on the idea that if you own all these different asset classes like small cap and large cap and international, that they're all going to behave differently, and if the market goes down, you'll have some protection. The reality is, it's never worked. It's never worked. It may add a little bit of protection, but the reality is the world is so interconnected now that all the markets tend to fall at the same time. They don't all go up at the same time, so you end up leaving some money on the table on the upside, and you don't really get the protection on the downside. And so stress testing, the conventional wisdom has always been that you dial down risk by having bonds.
Okay.
And that doesn't. Last year or 2022 was a case in point where bonds went down as much as stocks. And so there were a lot of people who had 60% of their portfolio in bonds, thinking they were adequately protected. That found out that perhaps that's not enough protection. And so understanding risk and stress testing is an important part of what a money manager should do, but also I think clients can do it on their own as well.
It's just there's so much in your experience, both of your experience, to accumulate and to dictate what needs to be done for the consumer to know where to invest their money. It's
a lot of moving parts.
You can't do it on your own. So it's just amazing to be able to have a company like yours that we can give our finances.
Thank you so much. That's why we love talking about it. We actually
just
love
do what you want to do with it.
Yeah, and we love sharing. And we feel like part of our job is to educate too, so that over the years, this is our clients' money, and our job is to help connect them with their money and help them understand all the moving parts. That's why we love doing something like this as well.
Let's talk financial planning with women. There's a lot with women, pay gaps and career breaks, and as a woman preparing for your future, and you also have a longer life expectancy than men. So tell me a little bit about that.
All of those things are so true, and they mostly apply specifically to women. Women usually take breaks for motherhood or to care for elderly parents or someone else in the family. There is a pay gap. We know that to be true. Still, even now, along with a pay gap means less contributions to your retirement account. That means less Social Security. It takes you longer to save as much as a man can in the same role. And so things like that are all things that we have to plan around for women. Longer life expectancy means more healthcare costs later in life. And these are all things that maybe you're not considering when you're in the working age, but they do affect your long-term plan.
Very much so.
Yeah. And is it true that women still earn 82% less than men?
It's shockingly, statistically, that seems to be true.
That's crazy.
Isn't that insane?
It is a little
It really is insane. And again, it's like Savannah said, and you couple that with taking breaks to raise children, taking breaks to take care of parents, living longer.
Right.
I told Savannah this funny story the other day, but my grandparents, this old Italian couple, played poker every Saturday night for literally 40 years. And I think there were like 6 couples, I don't remember. And the funny part is I used to hear them hollering and hooping, and I didn't find out until years later they were playing for pennies. But anyway, but over time, I saw firsthand, before this even made sense to me, I saw that over time there were fewer men, and ultimately this poker group became all women because all the men had passed. All the men had passed. And we just know that statistically, right?
Yeah.
Women are going to live a little bit longer. And yeah, to all of Savannah's points, I mean, a bigger pay gap, and we see it. I mean, I read the statistics in our industry, but we see it in our practice every day. Just the number of female clients that are controlling wealth, whether it be through losing a parent, through divorce, losing a spouse, their own retirement.
Yeah.
Right? I mean, I'm trying to think of all the different scenarios, but we see that women are controlling more and more wealth, and oftentimes are better investors too, honestly.
Oh, interesting.
Yeah.
What steps can women take to mitigate the loss, not the loss, but the effects of earning less or taking these breaks? Is there anything extra they need to do or prepare?
It comes down to prioritizing planning.
Okay.
We preach about it all the time because our main focus is through planning. Okay. Everything we do, we like to plan. We like to have a long-term strategy in place, looking at some sort of analysis for their goals and their savings and whatever we can do to help them achieve that.
Dealing with divorce, how do they protect their assets and future, financial stability through that?
I mean, the laws in Texas are pretty fair, and so more often than not, we're seeing a divorcing spouse end up with generally half of the assets. In some cases, again, it's kind of addressing women in particular. In some cases, they worked, some they didn't. But understanding the timing of it, like sometimes if we're dealing with a situation right now where a person was divorced 2 years ago and their spouse is just now retiring from a big energy company, and so this is the perfect time to sort of maximize the value of his pension. And so understanding the timing, having a good lawyer, of course, always helps. There's a term called a quadro, Qualified Domestic Relations Order, that gives you access to their retirement benefits. And so having a good quadro in place.
So wait, before someone's thinking of divorce, should they come talk to you first before their attorney?
Absolutely.
They do. Well, and sometimes attorneys bring us in as well.
Oh
Yes.
my God. Yeah. I didn't even think about, I don't need to think about those things. We've been together almost 30 years.
Right, exactly.
But now that I'm thinking about it, I was like, oh, yeah, you might want to talk to a financial advisor before you start making moves.
We have another client who she is entitled to her ex-husband's Social Security benefit.
Yeah.
That's just how it works. Yeah. And she's wanting to get remarried. And we had to advise her on the fact that if she remarries, she can no longer be entitled to her previous husband's social benefit.
And it was a significant benefit. And so it's just those things that have to be weighed, right? Are you willing to...
We're going to be boyfriend and girlfriend until we're 90.
Right, exactly.
Just a few more years.
Just a few more years, right? Yeah, so all those things have to be factored in for sure.
Yeah. And with Texas, we're a big corporate here, corporate employees. And tell me a little bit how it's different for employees of the corporate world to invest.
Yeah. So I would say that, this probably is something we deal with as much or more than anything else because of all the, the big companies here and, the Chevron, Exxon Mobils and Shells and ConocoPhillips. So these are all great places to retire from, right? Because you have obviously access to a 401k plan, a good company match, and then in a lot of cases a pension, which are very, not every company has that. And so that just almost always doubles the size of a person's retirement. But, again, we talk a lot about tax buckets and tax strategies. And so I would think the main thing I would want to sort of say to someone who's working for, whether they're sort of just beginning or they're nearing retirement, understand that not all money is taxed the same. Pre-retirement money is great. Pre-tax money is great because you're reducing your taxable income now. But all that money is going to be taxed as ordinary income when you retire. Understanding that the need for after-tax money is also important, and the need to have some level of Roth. And so most 401ks now have a Roth component to their 401ks so you can save. And I'll give you a couple of examples. And so if you take two clients that retired from XYZ energy company, they both accumulated $6 million. One of them did it all in their 401k, and the other one did it relatively evenly between the three tax buckets, maybe 2/3 in the 401k and the rest of it between those two accounts. The person that did all in their 401k, they're essentially going to be in a really high tax bracket for the rest of their life because all that money is being taxed as it comes out. And especially, there's something called required minimum distributions that you hit anywhere between 73 and 75 where you have to start taking money out.
Okay.
And so they're going to be in a high tax bracket versus this second person who we're oftentimes able to keep in a 5 to 6% effective tax bracket by managing where those dollars come from. So, 28% bracket versus a 5% bracket. And it's never too late. So if a person retires, say 58 years old, and they don't have to start taking distributions from their IRA until they're 73, there are a lot of planning strategies we can employ, like Roth conversion strategies, where you can start to convert some of that money from the IRA to the Roth, pay some taxes now in exchange for having a lower tax rate down the road. And by the way, that money that's converted to a Roth passes to their beneficiaries tax-free. And so understanding how money is taxed, certainly participating in the company's 401k and or the Roth. Right. And again, and doing some sort of an analysis to understand what their marginal and effective tax bracket is so they can have a good sense of how much, perhaps they could be putting more money into the Roth and less into the pre-tax account.
Well, it's good to know that you can adjust based on what you've already invested to lower the blow later of taxes, right?
Yes, absolutely.
Are there any special tax considerations when you have a corporate retirement plan?
Yeah, there are. And what is seemingly very easy on the surface really should be navigated carefully. And I'll give you a couple of examples. And so if you have a company retirement plan and you retire in the year that you turn 55 or later, then you are able to access that money penalty-free. Whereas if you roll that money over to an IRA, which most people do, now you're subject to 59.5. And this happens all the time. A person will retire and their well-meaning advisor will say, perfect, now we get to roll your money over to a 401k. And when they do that, they're like, oops, I needed income and now I'm going to be subject. And so just understanding that rule of 55 and that if you're retiring, because a lot of people do retire before 59.5, you often need to leave at least part of that money in the 401k to fund those first few years of retirement if those are the monies you're going to be needing to access for retirement. And so that's a big deal, right? And I see that one just kind of blown up all the time because people don't understand it. And all of these 401k providers, for the most part, are really, really good, but they're putting kids on the phone, with 90 days of experience that are helping people, through their rollover process and don't often know all the rules of the road. Okay. And so that's a big, the other one is, and this one can get complicated, but I'll keep it as simple as I can. But there's a strategy called NUA, net unrealized appreciation. So if you have company stock in a 401k plan, it has a special set of rules associated with it that you might be able to take advantage of. And for a lot of people, can be literally the biggest tax strategy of their entire life.
Really?
And so in simple terms, if you have low cost basis stock in a let's say you work for XYZ company and the stock is worth $100 and you have a chunk of it in your 401k, you can, when you retire, you can take that stock out of your 401k and put it into an account that you own individually, only company stock. This doesn't apply to any other investments. And you only pay taxes on the cost basis. And so again, you have $100,000 worth of stock that you paid $10,000 for, take it out, pay taxes on the $10,000, and let it grow now outside of your 401k. Because remember, 401ks are the least tax efficient vehicle to own in retirement. So if you can get that money out of there into an individual account, and now when you sell it, you're going to pay a 15% capital gains rate. And so the concept is relatively easy. I would say it is the most often thing that's done incorrectly. Okay. So it's just simple rules of the road. So if for example, a person retires in October and they're like, yeah, I love that whole NUA thing, I'm going to do it, but then they take a few dollars out in December to go travel with their family, they just blew their opportunity to do NUA. Oh no. We saw a situation with somebody that works for an energy company that had crazy low cost basis in a stock, he was talking to the person that handled the 401k, and financial planning 101 taught him to let this guy know that he needed more diversification. He said, you really should get rid of some of your company stock. In theory, that's true, right? He was undiversified, but he was retiring in 6 months. And by selling that stock, he blew an enormous opportunity to exercise this NUA option.
Jeez.
And so just things like that, right? Just the simple things, NUA, the rule of 55. Again, all this seems relatively simple, but unless you are made aware of it, then you just don't know. And so company stock's a big deal. Rule of 55 is a big deal. And
another thing to consider also is pension payment options. A lot of employers offer different options for if you're entitled to a pension. And that could be a lump sum, or it could be monthly distributions. They do joint with survivor. There are all different types of options. And really being able to analyze those choices and making it match your priorities is very important.
That's a really solid point. Because you have an option sometimes to take it as a lump sum, which I would say the majority of people do, but a lot of people really prefer that fixed. And I always tell people there's no right or wrong. I mean, we can graph it out both ways. But for some people, between their pension and Social Security, if they're covering 70, 80% of their income needs, that gives them quite a bit of peace. But yeah, that's a really valid point. And understanding, do you want it to part of it to take care of my spouse if something happens to me? Do you want to take it over 2 lifetimes, 1 lifetime? So there's normally literally 50 different options that you can look at for pension distribution.
The amazing thing is all the right questions. It's crazy how complicated it is.
Oftentimes, and we work with some very, very bright people who are very dialed in to their money, but how do you know these things?
No.
Unless you do it every day,
Exactly.
you just don't know.
And with Social Security, is there requirements of the max you can take from your retirement funds to also have Social Security? Is there any restrictions to that?
But if you make over a certain amount, then part of your Social Security begins to be taxed.
Okay.
And
And to take it back a step, you have to pay into Social Security to get it. And that takes time. And so not everybody gets a full benefit.
Right.
But if you pay into it every single quarter for 40 quarters, then you're entitled to a Social Security benefit at that point.
Yeah, that's exactly right.
That is the best part of corporate America.
Yeah, exactly. But to your point, and it's really valid because your income, the amount of taxable income you have is going to impact how your Social Security is taxed. And also your Medicare. There's something called an IRMA surcharge. And so if you make over...
One more time?
IRMA, I-R-M-A-A. I-R-M-A-A.
Okay.
And it's a surcharge that you'll pay for your Medicare the more money you make. And so all these things...
Didn't know that.
Yeah. And so they'll do a 2-year look back. And so when you retire, when you turn 65, they're going to do a 2-year look back at your tax return. And the amount of money you pay for Medicare is based on that number. And so people have to be aware. And so none of these decisions can be made in a vacuum because you're thinking, okay, I have an IRA over here. I was thinking about selling this property, but wait a minute, if I do it, all of a sudden now I'm going to have a really high Medicare premium. And so they all interact, your IRAs, your Roth, your Medicare, Social Security, and just understand that again, not to make a decision in a vacuum because they all impact each other.
It's very complicated.
Can be.
It can be.
idea.
That's why we talk about planning the way we do.
Yeah.
Yeah, exactly. Because money can't be looked at or managed in a vacuum because it impacts so many other parts of your financial picture.
And speaking of retirement distributions, cash flow planning, and this all kind of blends in together, right? But I mean, the basics, what exactly is a cash flow analysis?
It's kind of what we touched upon. So it's doing a deep dive. So it's taking all of a person's assets and the different types of assets. And so IRAs, Roths, after tax, real estate, and building an analysis that assumes a relatively low rate of return because we want to stress test it, assumes a higher rate of inflation, and we look at how much money a person needs or thinks they need in retirement when they want to. And then we do a year-over-year analysis of cash flow, where the dollar should come from, what impact that's going to have on their tax rate, and then oftentimes just sort of create a base case and then begin to look at how we can modify it from there, right? What tax strategies can we employ to create a better outcome? But there's 2 types of And again, not to beat up on any of the big firms, because we love them all, like Fidelity, Schwab. I mean, they're all Vanguard. They're all fantastic firms. But normally when you go like online and do sort of a financial or retirement plan, they refer to it as a goals-based plan. Like I'm this age, I have this much money, what's the likelihood I'm going to be able to retire? It's very basic. But without doing a deep dive into sort of a year-over-year analysis, you really can't. You don't have the full picture. You don't know what your taxes are going to be or where the money should be coming from, or should I be converting money to a Roth right now? And so it's just a very detailed. I mean, ours end up being 150 pages, but we don't try to bore people with all of it. But there are key elements to that plan that are super important.
We find it to be way more beneficial than goals-based planning. Not that there's anything wrong with it, but goals-based is kind of more of just like a yes or a no type of a deal.
Right.
And a cash flow, it puts the numbers to work, and you look at them year over year, and you can actually see where each dollar goes, and know if you're actually on track at the end of your life to reach your goals or not.
Exactly.
That's incredible planning.
It's so much fun.
Yeah.
It really is fun. And it's it's like the young couple that was in the office today that really does want to retire at 45. You can't, if we'd done just sort of a simple goals-based plan, you wouldn't know that, wait a minute, you guys, you need after-tax money to be able to do this. And this is exactly, we can play with scenarios. And if you do this amount on an annual basis for the next 15 years, you're done. You can do it. But don't do it over here.
Yeah.
Do it over here, right? Don't do it in your 401k.
Yeah.
And maybe pull back a little bit on that one out. And so it's just, being able to sort of see where the money is, see how it's moving, and then just do kind of a deep dive.
Yeah, that's excellent. And I want to talk more about real estate, my wheelhouse.
Love real estate.
And how real estate plays into your clients' portfolios. For me, I take great pride in finding hold properties for my clients to, have that part of their portfolio. Also specialize in second homes and vacation homes, and try to find great locations that are short-term rental ability so they can make some money while they have it. In your clients' portfolios, are you seeing real estate as part of that? A common thread?
Very much.
Absolutely.
Very much. I would venture to say that I see more wealth created in real estate than any other area.
Interesting.
Look, stock market's wonderful and we love it.
Yeah.
But the tax benefits of owning real estate, the potential to be able to enjoy a property and also potentially have it be an income producing property is just amazing. So yes, I mean, we have clients that own rental properties. We have some that own, shopping centers. Some that have a second home. That's exciting what you're doing. Where's the hotspot? Where do people want to live?
Yeah,
Where do people want to have a place?
San Miguel, we're going to be in San Miguel next month, touring there, and there's some beautiful homes there.
I've heard so many good things about it.
Yeah, and so we're teaming up with agents there, and we were just in 30A, the Panhandle of Florida.
So pretty.
I get a lot of clients who are wanting Colorado, Aspen, Vail. Breckenridge is beautiful and it's not as expensive. And so I'm setting out to really explore all these areas in person. We've been to Costa Rica, but Costa Rica is vast. There's so many places to invest there. But even Portugal, Lisbon, that's a hot spot, especially for Americans. And so, so I'm really excited for that venture to team up with some amazing people across the globe and be able to be there personally so that I can guide my clients to the right places based on their, lifestyle and their hobbies, and be like, no, you need to be,
you
need to be there. You need to be there.
Such a valuable thing to be able to offer.
Building wealth, right?
And building wealth. We have a client that has I forgot where his ranch is in Colorado. It's like 35 acres.
Outside of Vail. He
paid $1 million for it some years ago, and it's worth $7.5 million now. I mean, just incredible appreciation. And as you see, boomers are retiring. Not everybody wants to spend their summers in Houston.
No.
Right?
Yeah.
And it's the last place we want to spend our summers.
Yeah, we need a term for us. Snowbirds are usually people who, go from the snow to a spot we need to leave.
Yeah.
What's the opposite of that?
Yeah.
Right. And we see that, though. We see people either taking the summers and traveling.
Right.
Or they have a second home that maybe they'll rent out during the other months of the year.
Yeah.
And so, huge proponents. And sometimes people are surprised to hear us say that because we deal so much in the equity markets, but real estate is just a phenomenal way to build wealth and have something to enjoy as well.
Yes. Yeah, there's a benefit. You get to use it.
Yes.
And enjoy it.
Yeah, and the leverage aspect I talk about a lot. And so if you invest $100,000 in the stock market and it grows to $110,000, you have a 10% rate of return. Mm-hmm. If you control a $100,000 property and you put $10,000 in it, and it as a down payment, and now it grows to 110. Well, your return on investment is 100%, right? Because you have 10,000 in it,
Right.
it grew by 10,000,
Yeah.
and so you can't get that kind of leverage in the market without taking a tremendous amount of risk. And so
Correct.
the leverage aspect is just huge.
Yeah, especially if you have renters in there paying your mortgage.
Especially- exactly.
Like, that's the.
And it looks like
bread and
rates are
butter.
probably starting to come down a little bit, which is nice.
This is a good year, 2024, 2025. We have good hopes, and definitely, especially for holding properties. Investing, the past year, it's been a setback unless you're a cash investor.
Yeah.
Cash investors for hold properties make sense right now. Financing doesn't. But now that these rates are coming down.
Well, and then you have all these
invest it.
people that are sitting on 2.5%, 3% mortgages that don't want to sell to go assume a 7% mortgage.
Now, I'm going to tell you that if you are sitting on a 2.5% interest rate, do not sell your home. You become a landlord and you go take that equity and go get your place.
That makes sense.
The rent that you can probably get, the money, the income you can make, the profit on your home with the low interest rate will probably spend about 40% on your next house.
Oh, wow.
So
That's such good advice.
yeah, become a landlord with those low interest rates instead of selling it. So anyways,
That is
that's a good way.
such good advice.
Thank you so much for all your wealth of knowledge and sharing with us today. And what is the best way for people to get in touch with you?
Oh, goodness. I would say, so our website is postoakprivatewealth.com.
Okay.
And
We have our bios on there.
our bios, calendar links, and things like that. So we try to make it easy for folks to get in touch with us.
Well, I hope you enjoyed this podcast, and follow me, Summer Lynn, at Instagram. You're at Post Oak Private Wealth at
Post Oak Private,
Wealth?
yeah,
Yeah.
postoakprivatewealth.com.
It's a tongue
And ironically,
twister.
we're downtown Houston, but people think we were initially off of Post Oak, and so that's
yeah.
hence the name. But no, we're thrilled to be here. You have helped us do 2 or 3 deals, my wife and I.
Yes.
2 or 3 different investment transactions, and we just think you're absolutely the most wonderful realtor
Thank you.
on
I
the planet.
appreciate it.
So we're happy
Thank
to be
you.
here for you.
Thank you. Thank you. Thank you.
Thank you for having us.
For questions or suggestions, please feel free to comment. Details to subscribe, follow, or contact Post Oak Private Wealth Management or myself are below. Thank you for joining me on this unwavering pursuit to grow and be better together. Have a blessed day.